Ant Group is one of China's biggest financial technology companies and was set to have one of the biggest IPOs in history. They plan to list on both the Hong Kong Stock Exchange and Shanghai Stock Exchange, and the company was set to be valued at $313 billion and already secured over $3 trillion in orders, but the IPO never happened as the Chinese government stepped in the day before and stopped the IPO. In this video, we're going to look into what Ant Group is and why the Chinese government decided to step in and halt the IPO. Before we begin, don't forget to like and subscribe to support the channel. Ant Group started out as Alipay, which was an online payment platform similar to PayPal. Alipay was also part of Alibaba, which is a Chinese technology company similar to Amazon. Eventually, Alipay became one of the world's largest mobile payment platforms and had 1.3 billion users who have signed up for the platform, compared to PayPal, which only has 346 million users on their platform. They also control over 55% of all third-party payments happening in mainland China. In 2014, Alipay was rebranded and restructured into its own company called Ant Group, which is still an affiliate company of Alibaba Group. When you talk about business in China, you always have to remember that the Chinese government has full control over all businesses that are in their country. If they don't like what the company is doing, they can easily shut you down or hinder your expansion. Well, this is exactly what happened to Ant Group. Before its IPO, Jack Ma, the founder of Alibaba and Ant Group, made a speech at the Bund Summit, which is a two-day gathering of Chinese bankers and regulators that offer the country's leaders an opportunity to showcase their plans to the global financial community ahead of a key policy meeting in Beijing. This is where Jack Ma made his keynote speech, criticizing global financial institutions. He referred to the Brussels Accord, which is a set of international banking supervision regulations, as a club of the elderly. He also stated that traditional banks are operating with a pawn shop-like mentality, in which the financial industry is too worried about risk, and it's putting the economy at risk of not developing. He went on to state that Chinese economic system is in its youth, and should not be inheriting these broken systems, and should adapt the use of technology, and proposed a credit system based on big data in place of current mortgage lending mechanisms, so that borrowers will take on excessive loans after mortgaging their assets. While some praised Ma for taking a bold statement, many experts in the field criticized his lack of understanding of the Chinese financial system. For example, although the Chinese financial system is different from mature markets, it is definitely not in its youth, like Ma described. As early as 2017, the International Monetary Fund had already described China as having the world's largest banks, being the world's second largest equity market and the third largest bond market. So China's financial system being cautious about risk is definitely warranted, since it has a worldwide effect if things go wrong. Also, many traditional financial regulators see Ant Group's push into other financial products as a risk to their own. Ant Group now offers people loans and other financial services, but oftentimes acts as a middleman to these services. This means that Ant Group isn't actually taking out any of the inherited risk, but instead passing much of the risk onto other banks. They also get around a lot of the financial regulations by branding themselves as a technology company instead of a financial institution. After Jack Ma's speech, though, the Chinese government stepped in and blocked Ant Group's IPO over regulatory concerns, and possibly violating antitrust laws. Some say that Chinese President Xi stepped in personally to stop the IPO because of Jack Ma's statements. However, even before this, China was starting to clamp down on big tech companies like Tencent and Alibaba. Alibaba and Tencent WePay have an 80% market share in China's online payment industry, and this is concerning the Chinese government, as it could be a big structural risk to the Chinese banking system. Also, these tech companies are becoming too powerful, and China has to make sure they keep control over them before they get control over the government. China regulators do have a good point, though, that deregulating the financial market just for innovation might backfire, since it is such a big economy. It isn't the first time that China has tried to introduce new technologies into their financial markets. They introduced a digital currency, which is a legal representation of the official currency of China. This is not like Bitcoin because the currency is still tied to the central bank and has the same value as the normal physical currency. They released this digital currency in the testing stage, and with 1 week, fake digital wallets started popping up on the market. Another example is P2P internet loan platforms becoming rapidly popular in China, but subsequently collapsed, and this affected millions of people. After the blocking of the IPO, Alibaba, which has a 33% stake in Ant Group, saw its stock drop 10% and continued dropping throughout the week. It is still unclear when Ant Group is going to IPO, or if it will ever even happen. Some say it will take another 6 months before China drafts up new regulations on the company, that it will treat it more like a bank and less like a technology company. This will affect Ant Group's future levels of profitability and a new IPO price. But the company is still great and still has massive market share of the online payment industry in China. I still believe that China will not want to hinder these companies so much, as they are still ultimately working for the state. This just seems like a power move that is telling these big tech companies that the government is still in control, and if you undermine its control, it will step in. Saying this, I think this big dip in Alibaba's stock price is actually a great buying opportunity for the long term, as the company is still growing and is most likely not going to be too hindered by these new regulations. In any case, there's no turning back for financial technology development, and no stopping the transformation of the financial market. Old pawn shops will have to revamp, while those in the new financial sector cannot just develop indiscriminately as they used to. And using regulation to remove the instability without damaging the central banking system so that the financial market can advance is a skill that policymakers have to carefully balance. And with that being said, as always, thanks for watching, and like and subscribe to see more videos.